along tonight. The thought of Australians turning up to a meeting like tonight's meeting in normal balmy Sydney weather is inconceivable, let alone what you have to walk through to get here in a Norwegian winter. So thank you very much for coming along. As Trond said, we've been working together for probably 12 years now, actually 13. I think we first met when Trond read an article that I wrote in a non-orthodox economics journal called the Journal of Post-Keynesian Economics in 1995.
Something like
that was, yeah. And out of the blue, I got this query from a person challenging my mathematics in the article on the basis that where there was a negative sign in one of the equations, there should have been a positive sign. And I was too bloody busy at the time to take him too seriously. So I said, look, I'll get back to you in a while. And I finally got back and checked it. And what had happened was, as usual for technical articles, the typesetters don't know anything technical at all. And they had simply made a mistake in transcribing my equations. And yes, there was a minus, but there should have been a plus. So I wrote back to Trond saying, actually, yes, you were correct. There should have been a plus there rather than a minus. And he wrote back to me, and he's going to be embarrassed by this, and this is a good thing. He said, fantastic, I got it right. Orgasm, orgasm. I said, I knew you Norwegians were weird, but now I know just how weird. That was 13 years ago, and we're still working together. I don't know about his orgasms in the meantime, but I'll let him tell you that later. Okay, what has got us together tonight is this issue at the level of debt. And I've been focusing on the dynamics of debt for a long time, as has Trond, largely following a theory which is called the financial instability hypothesis. And if you want to follow up on what I'm talking about tonight to get some sort of overall framework for how we approach the nature of a capitalist economy, then the name to search for is a man called Hyman Minsky, M-I-N-S-K-Y. And Hyman Minsky, back in the 1950s and 60s, actually developed this hypothesis. Now, I know that's a long time ago for most people in the audience. I was barely born then myself. But back in the 1950s and 60s, the global economy, and particularly the American economy, and Hyman Minsky was an American, was absolutely booming. There'd been a period of dramatic growth after the Second World War. Unemployment was extremely low. The economy was in a period that Minsky himself called a period of growing tranquility. So to actually come up with a vision about financial instability 50 years ago is a remarkable thing. And to stick with that vision, despite the fact that all around you had apparent economic prosperity, showed the degree of vision this man had, because now people are talking about what we're going through at the moment as a Minsky moment. And they're saying clearly this is something that Minsky was thinking about happening 50 years ago. So how did he get there? But what I'll try to portray first of all is from the point of view of the Australian economy, what has been seen as happening in the recent historic past. And I've got sick and tired of reading this in the Australian media. We've been through a boom that has lasted 17 years. So if you take a look at the economic performance of Australia in terms of the rate of growth of the economy, that for 17 years, this has been the rate of growth. The red line is the rate of growth. The blue dots there are a dividing line that shows when the recently rejected Conservative government won office. So in 1996, the what's called the Liberal Party in Australia, which is actually a conservative political party, that party won office in 96. And then since that, there's been a sustained period of economic growth where the rate of growth of the real economy has been on averaging about 3%. Some dips below it, some above, but most of the time, the economy in real terms, as opposed to inflation-affected terms, has been growing by about 3% per annum. Now that's a fast enough rate of economic growth to mean that the rate of unemployment falls. And as a result, for 15 years, since there was a lag between rates of growth being greater than a certain level and unemployment falling, for 15 years our unemployment rate has been falling. So we started this period starting from 93, which was when the boom was, the slump before the current boom was finally ending, a rate of unemployment of almost 11%. It's fallen down now to be around the 4% mark, and until recently, certainly during the election campaign, the Conservative Party was saying, well, if you leave us in office, it'll fall below 4%. We'll have an unemployment rate with 3% in front of it. Now, Norway's rate right now I know is lower than that, and historically Australia's unemployment rate used to be below 2%. During the 1960s and 1950s, unemployment rarely rose above 1.5%, and if it actually hit 2%, that was likely to be seen as such an extreme economic failure that the party in power would lose office. Then we had the 1970s when unemployment hit 8 and 10% levels. There's been a whole generation that's used to unemployment levels like that. So this is now seen as an extremely good result. So the economy has been seen as booming for all that time. But what's actually been happening behind that, and this partly explains the mystery of why capitalism has appeared to behave so well for so long and then now suddenly hit a serious crisis internationally, is that for 43 years, the level of debt in the economy has been growing faster than the GDP. Now, if you imagine that in your own personal circumstance, it's as if for 43 years, your debt levels have been rising faster than your income. Now, of course, you can't sustain that sort of rate of divergence between income and growth indefinitely. This is what happens if you do. So the blue line is the level of output, measured in nominal terms because debt is something you incur in terms of today's prices. So to compare debt to output, I've got to compare today's current level of debt to today's prices. So that blue line is growing at about 7 to 8% per annum because that's the inflation-affected rate of economic growth in the economy. And as you can see, way back in the 1960s, and certainly obviously in the 80s and 90s, the level of economic output each year in the economy was greater than the level of accumulated debt. Then in 2000, the accumulated debt overtook the annual rate of level of output, and now it's about 1.6, 1.7 times higher. And that trend has been going on indefinitely, with a couple of minor reversions, but for that whole period, debt has been growing faster than GDP. It's more obvious if I do what they call a log linear plot. And that now converts the vertical axis to the log of the number. So if I double the distance, I get 10 times the amount. So that's 10,000, 100,000, a million, getting up towards a trillion. Sorry, that's $1 billion worth of debt. That up there is $1 trillion worth of debt. So you can see the slope of the line tells you how fast the levels are rising. And you can tell that the slope of the debt line is always, with a couple of exceptions, greater than the slope of change of GDP. So for that whole period, debt has been growing faster. And the vertical lines show change in government between conservative and moderately progressive governments in the country. So the blue lines are when a conservative government takes over, and the red lines are when a progressive government's been in control. And the trend really has no difference between each of those lines. This is something independent of political control. So what's happening here is, at least in Australia, is something that I can say is transcends party politics. It's something about the nature of capitalism that allows these things to happen. Now, clearly that's not sustainable indefinitely. And when I realised how bad that was, that's why I went on a bit of a public relations campaign to publicise this situation, because I thought this level of debt is now so enormous, the growth had been going on for so long, that there has to be a financial crisis coming out of it, which will be gigantic. And when that crisis strikes, given the fact we'd have a Conservative Party in power for so long, there was a possibility of a progressive government being in control when the crisis struck. And I could see what would happen is, as soon as the crisis struck, the Conservative opponents who'd been politically defeated would blame the new progressive government, saying it's your policy changes that caused this crisis, when clearly it was the accumulated debt that had occurred over 43 years and was independent of which party had been in power. That was what was going to cause the crisis. So I started making a public relations campaign about this. I established a blog. I started putting news reports out to journalists and so on. And to the credit of the media, Trond I know is a bit of a critic of the conventional media, but to the credit of the media, they picked up on this story very dramatically and promoted it quite a bit. So I now can say I've been successful in raising awareness about this in Australia, and Trond's giving me a chance to talk about it in Norway. I have no idea of the Norwegian situation. I would like to find out what that is. So it'd be worth somebody in this room seeing whether a similar trend applies in Norway, because I can tell you it applies in at least 15 other OECD nations. It's not just Australia I'm talking about, in other words. Now, when I've made this case, the conservative economic forces in control in my economy, and again I better elaborate on that a bit, Trond and I both have a non-orthodox approach to economics. Trond is actually a systems engineer. I'm a conventionally trained economist, but I've always regarded conventional economic theory as being inadequate to describe how an economy actually functions. And a large part of why that's the case is economic theory imagines the economy is always in equilibrium. Now, if you're in equilibrium, there's only one thing you should do, and that's nothing at all. If you're in equilibrium, why change anything? that's the nature of thinking you're in equilibrium. It actually reflects a 19th century mindset about the nature of systems, to believe they can always be in equilibrium. Now, of course, Trond, working as a systems engineer, is used to handling systems which are far from equilibrium, and therefore you have to have some sort of control to stop them becoming totally unstable. I don't believe you can necessarily do the same thing about capitalism as a system. I think it has some inherent instabilities which are not necessarily bad. But this particular instability I'm talking about is something which is very dangerous, and I think it's going to affect certainly the next 15 years of the economy. But anyway, in that guise, of course, most economists believe the system is stable. So when I challenge them and saying things are going on which show clear instability, they come back with some sort of rejoinder to me. And the rejoinder I've got from the Reserve Bank in Australia, which is our central bank, is that...
The word rejoinder means reply.
Reply, but also rebuttal, or reversal of your argument.
Okay.
Okay, and the argument they've said is, well, yes, debt levels are rising, but so are assets. And you have to look at both sides of the ledger. If you're in debt, that can be because you've borrowed money and you've wasted it going out and having parties and drinking Russian vodka. Or if you're in debt because you've bought lots of assets that are going to generate you an income stream in the future. So let's take a look at the assets. And this chart, the blue line I've been showing you beforehand is the level of, well, actually it was before the level of GDP, but this time the blue line here represents the level of debt. So it's that same highly exponential increase in debt over time. Thank you. Whereas the red line represents the value of assets. And those assets are the sum of the value of houses and the value of shares that people own. That's where most assets are either shares or real estate. Put those two together. And the black line is the gap between the two. And clearly that's been rising exponentially as well. So your net assets, the gap between what you own and what you owe, in the economy as a whole has been rising as well. And they're saying, well, you know, debt's going up, but so's assets, and net assets are still rising, so people are fine. There's nothing to worry about. But when you take a close look, those assets haven't been rising as fast as debt. And this takes a look at one particular class of assets, which are houses. And it looks at the debt that's associated with houses, which is mortgage debt. And says, what's the annual rate of change in each of those indices? So the red line is the annual change in the value of houses, and the blue line is the annual change in the level of mortgage debt. Now occasionally, like in 1987, the red's well and truly above the blue, so that particular year the value of the house, average house, rose far faster than average mortgage debt. But you can spot there's only about 3 years there and 1.5 years there where the rate of growth of the housing, the value of houses, has exceeded the rate of growth of debt. For the rest of the time, the rate of growth of debt's been far higher than the rate of growth of the value of the index. And that's commonplace when you take a close look. Debt's growing faster than assets. Yeah.
Altså, jeg vet ikke om mortgage er kjent, men det er altså pantelån i bolig. Så mortgage er pantelån. Så snakker om boliglån. Yeah.
And the reason, the fact that occasionally the red line is above the blue line is not because we're building many more houses. There are two components to most economic concepts. I'm very disparaging about the usual supply and demand analysis that most economists practice, but you can break down any change in economics to a change in quantity and a change in price. Now, if you're changing the quantity of assets you have, you're increasing your physical capacity to produce output. And I think that's normally a good thing, leaving aside global warming and peak oil and so on. But if you're increasing the price of those assets, you're not increasing your physical capacity. And that means that you'll get more expensive assets, but not necessarily a greater capacity to produce output. So that's what I've done, take a look and said, well, where's this change coming from? Are we building more houses in Australia? Or are the houses simply still the same number of houses, but they're simply costing more? Well, this takes a look at houses again and breaks down the annual change in houses into the annual change in the volume of houses, how many more houses are we building in Australia, and the annual change in the price. The blue line is the annual change in volume. Now that's not quite a flat line. If I change the scale just to look at that, there are obviously perturbations up and down a bit, but you can tell the change in price each year has been far greater than the change in quantity. So most of the increase in the value of houses comes down to making the existing stock of houses more expensive. Now, of course, that's good if you own a house. It's not so good if you rent a house or if you want to buy a house. And that's becoming a dilemma in Australia. The price of houses has got so high compared to incomes that there's now what they call an affordability crisis. People can no longer afford to buy a house. So a trend which has existed for a long, long time of people stretching themselves to buy a house by borrowing money to get into debt but have enough money then to buy the houses given the current price level has got so extreme that most people of your age in an audience in Sydney have given up on buying a house in Sydney and now considering either moving to a cheaper town somewhere else in the country or just renting for the rest of their lives. Now, of course, what that means is people who had bought a house and thought they were going to sell it for a profit later are suddenly finding that the market to buy those houses has evaporated. Simply because for anybody to buy a house off them, they have to take on more debt than those people took when they bought the house 4 or 5 years ago, and people aren't willing to do that anymore.
Is that the reason why the curve is going down at the end?
At the end now we're heading a bit of a crash in prices. Ironically, America, of course, as you're now aware from reading about the subprime lending crisis in America and the housing price crash over there, America's had a version of a housing boom as well. But in America, they actually did build, during that last boom, a substantial number of houses. And as a result of that, at the end of the boom, they have far too many houses that are neither being sold nor rented. So there's an enormous level of unsold houses on the market, a huge overhang of houses that people wish to sell that aren't being sold, and also a huge overhang of rental properties where people are trying to rent them out, and the supply of available apartments far exceeds demand. So rents are crashing in America and so are prices. In Australia, on the other hand, we're a slight idiosyncrasy here. We really have what I call a borrowing boom. People were borrowing money, but rather than building houses, they were buying existing ones. Our population is still rising because of immigration and natural population growth. So we're now having a rental crisis of inadequate number of houses available. So our price dynamics are a bit different to America. But we have what I call a borrowing boom rather than a building boom. So we're having a rental crisis now. We've gone from one crisis, which was one boom, a so-called housing boom, to a rental crisis, which is a bit like going from an enormous Christmas party to being in absolute sunshine instantly afterwards. What happened to the snow that was supposed to be out there? Why didn't we accumulate some snow? What's going on? So, taking a close look at assets again, with this argument that the increase in assets balances the increase in debt, so we're okay overall, I thought I'd take a look at what are we actually getting out of the housing stock. Because when you think about housing as a product, the service that housing provides is somewhere to sleep at night. And you could do that in two ways. You could own the house or you could rent the house. Now, that comes back to the incomes you're earning, because you pay for your accommodation out of your weekly income. So the Australian Bureau of Statistics produces a series that says, well, what rental income is being earned in houses? And they add up the actual rental for houses which are owned by landlords and are being rented to tenants. And it also makes up what they call an imputed series, where they say, well, they're also owner-occupiers. What would they have to pay to rent the house they're in? And they work out, therefore, the income stream, in effect, that's coming out of that imputed income from the houses. And that gives you an idea of the rental income out of houses, as well as the blue line again, telling you what you're paying in interest payments each week for each year to sustain, to hang on to the house, whether you're renting the house out or you're living in the house. So the blue line is the rental interest payments now. That's debt times the interest rate, effectively. And you can see how that's absolutely exploded during 2000, from 2000 on. The red line is the value of rental income, both the real and the imputed. And both those have been measured on the left-hand axis here. On the right-hand axis, I take the gap between the two. And you can see that peaked about 2000. And now, the gap between the rental income out of properties and the mortgage you're paying has almost reached zero. Not because rents have gone down, they've actually been increasing, but because the mortgage payments have gone up so much that people are making barely a margin over the rental income alone. And of course, in addition to paying a mortgage to own a house, you have to pay depreciation costs, you have to pay maintenance and so on. So when you take those into account, people are substantially negative on the houses already. So the value of assets we're seeing is illusory. And again, taking a close look at what changes have occurred since 1996, which is only a decade ago, and we know we've been in a low inflationary period in the last 2 decades. Prices of houses have increased 250%, far faster than average commodity prices have risen. But mortgage debt's gone up 520%. Now, since I wrote these slides, this has probably gone up slightly further. That's now over 550% increase in mortgage debt. And this gives a bit of a comparison by reducing both mortgage debt and the price of housing and the value, which includes price times quantity, to 100 in the year 1996, and then graphing the change over that time. There's the change in prices, there's the change in debt. So we're getting massively more indebted over time. And in fact, even though America wins the news services about the housing bubble, and everybody talks about how ridiculous American house prices got to be and all that sort of jazz, we're actually worse in Australia. The blue line is Australia's housing price index. The red is America's. You notice we took off more rapidly, followed much the same trend, peaked for a while around 2004, and then exploded after that, still going up. America, on the other hand, has turned down, and housing prices in America are now falling by more than 1% every month. Now, share prices, as you know, can go up and down by 5 and 10% in one day. They changed by 5% a couple of days ago in America. Housing prices are much more sluggish than that. But now, in effect, American housing prices are falling by more than 1% a month. That's an unprecedented rate of fall in the price of houses, which is what's a major part of the crisis the Americans are now feeling. To see how much debt's become a dominant part of our society, what I'm doing in this graph is comparing the level of new borrowing each year, so how many loans people take out for new houses each year, to the level of GDP that year. And back just 20 years ago, the ratio of new debt to GDP was only 5%. Now it's 25%. So new loans to buy houses represent 5 times as much as a share of income now as it did just 20 years ago.
Steve?
Yeah?
You will sooner or later explain why you call it Ponzi.
Yeah, well, pardon me. This is a Ponzi. I'm referring to people being driven by speculation rather than real investment. One of the good things about capitalism that a guy called Joseph Schumpeter in particular champions is that it forces us to innovate. You don't win in capitalism if you don't innovate new products, whereas you can remain a feudal lord for a substantial period of time without innovation. So in terms of comparing feudalism to capitalism, one of its strengths is innovation. And that involves speculation. Will this product work in the future? If I make something I call an iPod, will I gain market share over those who still keep on producing tape recorders for music, stuff like that? That's a good thing. But speculation can also be pure gambling about the price of assets. And Charles Ponzi was the ultimate person who got involved in that. He was a speculator in 1919 to 1920 in Boston in America, which is the capital, in effect, of America's both financial and intellectual elite. And the vast majority of this, a large part of this population, was investing in Ponzi's bank in 1919 to 1920, or Ponzi's firm. Now, in fact, what Ponzi was doing was offering an enormous rate of return to people. The rate of return he was offering was actually double your money in 90 days. I haven't worked out what that is in terms of percentage rate of return per year, but it's something like 500 or 600% rate of return. And people, rather than saying, you've got to be a con artist, let's throw you in jail, said, oh, here's my money. Gave it to him, see what happens. Well, you know, Trond's the first one, and you're the second, and you're the third, and you're the fourth, and you're the fifth after about 90 days, which is when you got promised to double the money. So what he does was he gives you those 2 people's money on day 90. And then you're the 6th, 7th, 8th, 9th, 10th, and so on, and he then gives you those 4, and so on. Well, as a result, the people who get in and get out early made an enormous amount of money and sucked in many, many more people who do the same thing, but he was forever increasing the amount of deposits he had to hand out. So the only way he could succeed was to have a dramatic increase in the number of people coming in through his doors each day, so that he could pay the ones who were earlier in the queue by 90 days. And they kept on going until the whole thing came crashing down.
So you're saying that Charles Ponzi has become a key sort of expression for a pyramid game.
He's become the name that's associated with pyramid schemes. Mind you, he's an interesting personality. I read his biography just recently called Ponzi's Scheme, and it's a very recommended read from my point of view, to see what's going on now and see a bit about this human being. And Ponzi was somebody who, in the classic Australian sense, believed his own bullshit. It's okay to be a con artist as long as you don't believe your own bullshit, okay? You can get out and get away. He believed it. He actually thought he could produce wealth out of this scheme. He didn't run away. He was arrested, did end up in jail and died penniless in Brazil later on. But the guy had this strange humanity too. He actually donated at one stage in his life. He was always coming up with get-rich-quick schemes wherever he was in America. The last one was the last one that actually clicked with people. But he had this scheme that involved providing water to a mining site in a town he was living in. He was just about to carry it out when the nurse at the mine suffered a horrific accident where she was burnt, massive burns over most of her body, and she needed a skin graft to stay alive. Massive skin graft. I don't work it out in centimetres, but the amount that the doctors thought she needed was 70 square inches. I think that's about 200 square centimetres of skin. Otherwise she was going to die. And nobody came. They asked the town of about 50,000 people, to volunteer, each giving 1 square inch, which is about 10 square centimetres, I think, of skin per person. Nobody came forward. And Ponzi was asking what state the nurse was in to the doctor, and he said, well, she's going to die because we haven't even got a single inch of skin volunteered out of this whole town. And he said, you have all the skin you need, you can take mine. He donated 200 square centimetres of his own skin to help this woman stay alive. So, as much as I'll put him down in terms of what he did in financial scheming, the man had a bizarre humanity. And this is very much believing your own bullshit. He survived. He actually gave 2 skin grafts to keep this person alive. So he's not entirely an arsehole. But most of the people who've been named after him, I think, deserve the title of arsehole as well as Ponzi speculator. Anyway, the whole society's got caught in this Ponzi speculation bubble in Australia. So, from 5% of income each year being the level of new borrowing, 25%. But across the same time period, rather than actually building houses, we've simply gambled about the prices of existing ones. The Australian Bureau of Statistics breaks down lending to borrowers for households in 2 series. One for people who are buying somewhere to rent out, and the other for those who are buying to live in the house they buy. Now, back in 1987, virtually 70% the money being lent to investors was actually building a new house, which actually is investment. But over time, you can see what happened. Now, less than 10% of the money being lent to investors or owner-occupiers actually builds a new house. 92% of the money is simply used to buy an existing house. So all those investors are really doing is speculating about the price of houses, expecting those prices will rise. And it's just like the borrowing from Peter to pay Paul scheme that Ponzi was doing. This is now taking a look at that debt series by dividing debt by GDP. And this is what got me involved in doing a public relations campaign about this, because I was actually asked to appear as an expert witness in a court case to defend a family who were being evicted from their home for failing to pay their mortgage. And the case I was asked to make is the public interest case, that the contract they were being forced to honour was unconscionable, it was too excessive, and don't worry about the impact on them, what's the impact on the rest of society of that contract being honoured? In this particular case, the same lender had issued 7 consecutive loans to this family when they started with a debt of $100,000. 1.5 years later, they had a debt of $260,000. And he kept on issuing loans to them until such time as the gap between the value of the house and the loan was no longer enough for him to be able to expect to sell the house and make a profit. So on loan 7, he stopped extending the money and sued them for occupation, knowing they were failing loan after loan after loan after loan. So I was asked to defend this case, and I made an argument about how this increasing debt burden was affecting the entire society. And I made a throwaway line while writing my expert witness case saying that debt to GDP ratios, debt to income, have been rising exponentially in Australia. Now, I realised that I couldn't get away with making what I call a hyperbolic statement like that in a court case as an expert. I could do it if I was a barrister, that's fine. They do it all the time. But as an expert, I had to say something which was verifiable by the data. So I went and got the data, and that's the chart I saw. And my jaw dropped on the floor. That is clearly an exponential rate of growth in debt to GDP, and it's been going on since mid-1965. And when you work it out and say, well, taking that level of debt then as a ratio of GDP and putting that as an argument to an exponential rate of growth, what's been the average rate of growth over those 43 going on 44 years? The answer is 4.2% per annum. So for that whole period, debt's been growing over 4% faster than GDP. Now, if you want to know how fast that means you're going to double your debt compared to your income, you divide 4 into 72, as it happens, magic number, and you find about 16 years, or thereabouts, will be the period between debt doubling every compared to income every 16 years. So it's more than, it's doubled and doubled and doubled again, almost, over that period. And clearly there's something systematic, because again, I'm showing political regimes here. Now, this was when the first major political change after the Second World War occurred about near 1950, when a government called the Menzies government was elected. And you can see there was no trend in the ratio of debt to GDP between the end of the Second World War and the mid-1960s. But from the mid-1960s on, regardless of whether there was a Labor government or a Liberal Conservative government in power, with a couple of little bubble exceptions here, that trend just continued. And clearly, you can't go on doing that forever. I think that's why we're reaching the crunch point we're seeing both in my country, but also especially in America. We've just gone on for too long. And to say why it isn't just Australia that's doing it, this is now showing the United States household debt. So the previous charts all included both households and businesses. This is just households. And you can see that America's household debt compared to GDP was always larger than Australia's until the last few years. And our debt levels have accelerated much more rapidly than America's over that time. But that would just be one major and one very minor economy. There's only 20 million Australians, so we're fairly small fish on the international market. But in response to my arguments about the danger of this, our Reserve Bank did a study and said, well, let's look at the whole OECD and see whether any other OECD nations have the same situation as Australia. And they found that there were 15 OECD nations where the same thing applied. It's hard for you to read them across there, so I'll go across the line. The vertical bar, they're ranked by the size of the brown bar, and that's the annual increase in nominal GDP, which includes both increases in real output, but also the effect of inflation. So Ireland obviously had very high inflation as well as economic growth, whereas Japan, right down the other end, had very low inflation over the whole period. I wish I'd actually ranked it by the gap between the two, because the second series shows the annual growth in nominal debt. And you can see that Ireland has a fairly substantial gap, but nothing on the gap that occurs in the Netherlands. So I'll go across the country sideways. And the interesting thing from your point of view is how big is the gap between the two bars for each country? Ireland, Spain, Australia, UK, New Zealand, Netherlands, Italy, Denmark, Finland, United States, Canada, Austria, Switzerland, Germany, and finally Japan. The only significant omission from that list of OECD nations is France. Every other nation's had the same impact. I would be curious to see whether Norway's in the same situation. So this is a global phenomenon. And curiously as well, it's also one that has historic parallels. Because again, in response to my critiques in the media, the Reserve Bank took a look at the long-term, 150-year history of debt in Australia. And this is the chart they produced by looking at the debt to GDP ratio in Australia over the last 1.5 centuries. Now, my jaw had already fallen on the ground when I saw this part of the chart that I knew from the current data. When I saw these two as well, I thought, holy hell, are we in for a great 21st century? Notice that the debt to GDP ratio, the data starts from 1860, but I start just at the beginning of the previous bubble in 1880 to make it all fit on one chart. You can see a bubble there, and a really big bubble where we are now. So the debt levels we're experiencing are greater than what occurred before the Great Depression, and greater than what occurred during what's called the Melbourne land boom. So we know historically that bubble was caused by speculation in a town called Melbourne, which now has a population of about 4 million, but I think back in the 1890s probably had a smaller population than Trondheim. But that speculation about the value of Melbourne houses increased the debt levels in the country from under 40% of GDP to over 100% in a very short time. Now, the reason the speculation occurred in Melbourne relates to the fact that at that time gold was discovered in the surrounding countryside, and for a short while the countryside around Melbourne was the world's major gold producer. So you got people coming to mine the gold, you got gold being found, you got people speculating about transferring their wealth out of gold mining into something else. We had a land bubble. When that burst, we had the most severe depression in Australia's history. The 1890s depression was regarded by the Reserve Bank, when they looked at the data, as actually more severe than the Great Depression.
Reserve Bank i Australia er samme som Norges Bank I Norge.
Of course, we all know what happened during the 1920s. We think about the 1930s in our memory these days, but of course the 1920s were the roaring 20s, the time of the Great Gatsby and all the parties and the wealth and the, what's that dance they used to do in the 1920s? The Charleston. And that particular, like the 1920s dance parties, that whole mentality at that time, people were borrowing money to do it. Of course, we know what happened afterwards, the Great Depression and the Second World War. Then we had a period of stability, a very brief period of almost no change, and then boom. And I'm now nicknaming this period the baby boomer follies. We've made our 1920s Charleston dancing great-grandparents look incredibly responsible by comparison. So what happens after something like that? Well, if history is anything to go by, something very serious and very painful comes afterwards. What I've done here is take a look at that short boom period in each of those three booms. So in the 1890s, the boom only lasted 9 and a bit, sorry, whereabouts are we? It lasted just 12 and a half years. And in that 12 and a half years, debt grew roughly by 9% per annum. In the 1920s, the boom began in Australia in 1925 and finished in 32 in terms of the debt level, not of course the economy. And it grew at 9.5% per annum. Our boom began in 1964. When I prepared this chart, I was 3/4 of the way through to 2007. It only grew at 4 and a bit percent, much lower than the previous rates of growth, but it kept on going for far longer. So as a result, the increase in debt is 3 times virtually what happened back in the 1890s. And we've got twice the level of debt we had during the Great Depression.
But when you have the word correlation there, it means how well it conforms to a perfect exponential function.
That's right. And economists are normally extremely happy to get the correlation coefficient, which is shown, whereabouts have I got that? Here. Economists are ecstatic when they get a correlation coefficient in their models above 30 or 40%. I'm getting 0.99 there. That's 99%. I'm not happy at all. I'd hate the fact that I get that correlation. It's far too simplistic, which means there's something very systematic lying behind this phenomenon. Now, ironically enough, in looking at that data, our Reserve Bank wasn't worried at all. And this is now talking about how economists think, because this is a quote from the Deputy Governor of the Reserve Bank of Australia, interpreting that very chart I've shown you. I'll let you read it yourselves.
Så dette må jo da, altså den som nå uttaler seg, det blir da nestsjefen til Svein Gjedrem, bare I Australia.
Notice I think what's happening is finance is being democratized. In my opinion, just like some countries shouldn't have democracy imposed upon them, neither should finance. Democratizing finance is about as sensible as invading Iraq to democratize Iraq. He thinks it's got further to go, and where's it going to end up in? So he thinks that that process I showed you is heading toward an even higher level of debt, where it will be some equilibrium, so it will suddenly go horizontal. That is not a chart that I see going horizontal. But that's the sort of model he's got in his mind. Now, the reason I've got skip model there is that Trond told me not to hit you with any mathematics, so I'm jumping over a mathematical argument here about how money is created. If anybody wants me to go back to it, I'll do it on request later. But I've got a model to explain why on earth do we accumulate that much debt.
Steve, and just if I understand your argument right,
yeah.
And I am the deputy manager of the Reserve Bank of Australia.
Okay.
I will take your graph, which is to the right here, and which looks like this.
and goes like this.
Yeah, I can know twice.
And this, okay, but I can't
Yeah.
go higher.
Yeah.
And this is where we are now. This is today. So what he is saying,
Mm.
I mean, what you are saying is that we will get something like
Yes.
this.
Mm-hmm.
What he is saying is that
Yeah.
this will happen. That is what he says.
That's what he's
Okay.
saying. Yeah. So, what I gave in the slides I've skipped is an explanation of why banks are willing to lend as much money as they do and where money comes from. And I'll go back to that if anybody's curious about it, but it does involve a bit of mathematics. I've tried to make the mathematics digestible, but Trond said don't spoil anybody's dinner by trying to do it during the talk, so that's for later. But I explained why banks are very willing to lend money. Banks create money out of nothing, and that's a necessary part of capitalism. It's not a bad thing. What's bad is that since banks have a willingness to lend as much money as people are willing to borrow, if people themselves are willing to borrow enormous amounts of money for speculation, banks will fund that speculation until you hit a crisis. So it's a fundamental weakness in capitalism that let banks decide how much credit to extend. So the question is, why do we take on so much debt? And this is where Minsky's theories comes in. So I'm going to give you a very rough, very fast introduction of Minsky's theories about why do we accumulate so much debt compared to income over time. And it gives an explanation for that cycle I've shown you in Australia. I'm glad Trond's put this little graph on the board. Why do we go through this cycle over time? Hyman's explanation is actually for the ups and downs I showed you on this chart. This is actually a longer story again, which I think makes me regard Hyman Minsky as somewhat of an optimist. But he takes an economy in historical time. Now, if you're in a historical time, there's been some historical event beforehand. I use the word historical time because economists do two things very badly. A, they normally don't consider time at all. So they leave time out of their arguments entirely, in terms of supply and demand, for example, without relating that to the flow of demand at a particular time versus the flow of supply at a particular time. They abstract from time completely. Secondly, if they do consider time, they consider what they might call logical time, where t minus 1 occurs before t and t plus 1 occurs after t. They don't consider time in history. But of course, when you say historical time, I'm saying 2007, 2008. And I'm saying sometime in the past. Let's choose 1987. There was a financial crisis, or 1989. So if we look back historically and say there was a crisis in 1989, that caused a recession, a serious recession in 1990-93. And anybody who went through that ended up being very conservative. They survived financially the whole crisis. They came out of it extremely conservative compared to the previous boom period about how much money they would borrow. And that applied not just to borrowers, but also bankers. In Australia in particular, there were two banks that almost went bankrupt. One did actually. One of them had to be taken over by another bank. The other came very close to collapsing. So there were lots of financial failures from both banks and firms. Now in that situation, it means that after the experience, anybody who thinks of borrowing money will only do so if they're very confident that they will be able to carry the debt they have to service over time out of the cash flow from the business. So they're very conservative on both sides. But because they're conservative about how much risk they'll take on, and because the economy has actually survived the crisis to some degree, most of those projects succeed. And since those projects succeed, people look back on it and say, oh dear, if only we borrowed more money, we would have leveraged more of our gains and come out ahead. So they think we were too conservative, and they then revise down the risk premium they put on a new project. And since they revise those premiums down, the next time around they're willing to accept more debt compared to equity and income. And they're also likely to say that any asset they might be considering buying is actually worth more money than they valued it at previously. So the way that Minsky summarises this in an English language phrase is beautiful. He simply says, in capitalism, stability is destabilizing. A period of tranquility will make you think things are going to improve over time, so your expectations will improve. So tranquility leads to rising expectations, which leads to speculation and a runaway economy. And as he also said, and this differs from a lot of Marxist critics of the economy, he says the fundamental instability in capitalism is upwards, not downwards into a slump and depressed conditions, but upwards. But of course, in a financial system, that encourages you to borrow more money, and that's what depresses you, when you finally borrow more than you can sustain. So with this upward period going on, ultimately you get into what Minsky calls the euphoric economy. And by that he means everybody's behaving as if they're on ecstasy. And a fair portion of the people in the finance markets, of course, are on ecstasy. So in that situation, you get self-fulfilling expectations working up in an economic sense as well. Because there's been a decline in aversion to risk, there's more investment going on. And because the investment going on, the economy grows faster, which validates some of those investments. Asset prices are rising, and because asset prices are rising, it's okay for any idiot can make money out of buying and selling assets in a rising market. Any idiot looks like a genius when prices are going up and they're buying and selling all the time.
When you say assets here, you're thinking of primarily stocks and
houses.
Real estate.
Stock, houses and real estate.
Okay.
They're the prices that rise. And then also, this is one thing I explained the dynamics of in the previous slides, but because people are willing to lend more money and to borrow more money, the actual amount of money increases. So you have an internally generated increase in the money supply, which itself gives you more economic activity and also drives up asset prices even further. And on goes asset speculation and so on. Now ultimately you get a whole class of people that Minsky titled Ponzi financiers. Remember our friend Charles Ponzi. And they said the only way these people can make money is by selling assets on a rising market, because they take on more debt than the cash flow of the businesses they buy with that debt. Now the case of Charles Ponzi himself, giving the money of later depositors to earlier depositors, obviously is unsustainable. But Ponzi speculators in general are people who borrow money where the servicing cost on the debt they accumulate is greater than the income of the asset they've bought. The classic instance in my country's case was a guy called Alan Bond, a good name for somebody who speculates. And Alan Bond bought a brewery in Brisbane, in Queensland, which is called 4X. It's probably because the people who drink the beer, that's all they can manage to write when they're trying to pay the bill at the pub. Alcohol is a major consumption activity in Australia, and certainly in Queensland, people are regarded as being heavy beer drinkers. So Alan Bond bought the 4X brewery and renamed it to the Bond Brewery. And he then went bankrupt while owning the Bond Brewery. Now the joke was, how can anybody go bankrupt selling beer to Queenslanders? Well, the answer was he borrowed far more money to buy the brewery than the cash flow of the brewery itself generated. So he went bankrupt selling beer to Queenslanders. So Ponzi financiers are incredibly sensitive to the level of asset prices. If asset prices aren't rising, they go bankrupt instantly. And that's what happened to Alan Bond. Not quite instantly, he wasn't quite as fast as some of the others. But the cash flow is always less than the debt servicing costs. So the only way they can sustain themselves is by continuing asset price inflation. Now, ultimately, people who aren't speculators are forced to sell the assets they bought to stay in business because interest rates have risen, cash flow is more difficult and so on. So they come in and they start selling a couple of breweries. And all of a sudden, you get a collapse in asset prices, which is what we're seeing in America now with the housing prices. So people are forced to sell assets who didn't want to. The asset market is actually much smaller than people think it is, much more susceptible to increased supply. And asset prices stop rising, and suddenly Ponzi's go bankrupt. And that's what you'll see quite regularly. The people who are the previous darlings of the financial pages of the newspapers, who are seen as being geniuses, they're the first ones to go bankrupt. And the whole reason for their genius is they're utterly dependent upon rising asset prices. Again, to give an Australian example, a guy called Christopher Skase was one of our major speculators in the 1980s. And Christopher Skase made a takeover bid for the American movie-producing house MGM, which is ultimately purchased by Sony. So that's why Sony produces so many movies these days. The takeover bid was rejected by the board of MGM, and the takeover bid was in 1989 or thereabouts was for $3 billion US. The next week, Christopher Skase went bankrupt because he couldn't pay a $12 million loan instalment. And as my flatmate at the time would say, it's a bit like making a takeover bid to buy a block of apartments and then going bankrupt because you couldn't afford the electricity bill on one apartment. So he had a $3 billion takeover bid, bankrupt because he couldn't pay $12 million. That's how susceptible those people are to needing asset prices to rise and to continuing getting borrowed money. So they go bankrupt because they can't sell their assets for a profit. They have a debt servicing level that far exceeds the cash flow of the business, and asset prices collapse, and you're back where you started from. You're back in a debt-induced recession. So I started from memory of a debt-induced recession, you get back to one again. And that's the sort of dynamic that Minsky talked about to explain how you have this debt level cycle occurring. But he also said that each time you survive a crisis, what happens is you become complacent about the level of debt you got to just before the crisis hit. So you ratchet up. The debt level goes up a bit, and then you come down. Up a bit, and you come down. Up a bit, then you come down. You keep on going up until you get to a point, ultimately, where you strike a crisis like the Great Depression, or I'm afraid to say like the one I think we're going to strike now. Now, he has two attenuating arguments, and I'll go through this very quickly because it's really the main argument I'd like you to see, and I'll put this on Trond's website for anybody who wants to check in more detail later. But if high inflation occurs, that's actually a good thing in a crisis because it helps you repay the debts because price levels rise, incomes rise, but your debt remains in nominal terms. So high inflation can actually help you out of a crisis like this. Now, part of the logic there is that what's actually been going on, which caused the crisis, is inflation in the price of assets. But to finance assets, ultimately the money you get to pay for assets comes out of the cash flow from commodities, whether you're selling your labour or you're a store person selling commodities. If you get a divergence between those price series for too long, ultimately you can't service the debt and you'll have a crash. And then you have to get those prices back into some sort of alignment. Now, there are two ways that can happen. One is by having those asset prices come down. But if that happens, they come down and they can drive down commodity prices as well, and you get deflation and end up no better off than you were beforehand. Or you can cause positive inflation. What Minsky is saying in this situation, you should actually try to cause consumer price inflation to counteract accumulated years or decades of asset price inflation. And he also argues in favour of a large government, because he says a big government, what a government does is provides a cash flow that people who are in debt wouldn't have otherwise during the crisis, and the cash flow lets them repay their debts. Now, I don't think the government can get on top of the level of debt we've got these days, because when we take a look at the level of debt and see what is the real burden on the economy, this chart gives you an idea in Australia's case of how severe that burden is. As I've mentioned, I've been talking about the ratio of debt to GDP as the driving force. And of course, that's only a problem because you have to pay interest on debt. So the combination of the debt to GDP ratio and the interest rate tells you the nominal burden that that debt level is putting on you. But inflation also varies it because inflation actually reduces the value of debt as well. So I've got to take all those factors into account to say what's the real burden of debt on the economy. And then using that enormous data series I showed you from the Reserve Bank going back to 1860, I could show that back in the 1890s, the real debt burden on the economy was almost 20% of GDP. In the Great Depression, it was about 12.5%, 13%. Now, in both those periods, prices were falling dramatically. In the 1890s, prices were falling by up to 15% per annum. In the 1920s, prices fell by up to 13% per annum. And that huge drop in prices actually increased the real burden of debt. We now have inflation running at 3 and 4%, but despite that, we have a higher debt burden than during the Great Depression. So if we fall from inflation to deflation, we go from rising prices to falling prices, which is a possibility in the current circumstances, we'd have a higher debt burden than even the 1890s. And I think we'd be in one hell of a recession.
I noticed that this curve of yours goes below zero at certain instances. Can you explain on that?
Sometimes there's been very high inflation, like during the 1920s period and after the Second World War. So at that time, inflation was much, much higher than the normal interest rate. So you might have inflation of, say, 12% and interest rates of 3%. Well, your wage was increasing by 12% per annum. Interest rates were only 3%. You're actually almost being paid to borrow money. So that period there helped Australia and also most of the Western world recover from the levels of debt accumulated during the Great Depression. So there's times when that burden will be negative because interest rates are actually lower than the rate of inflation. And I want to now put a macroeconomic perspective, getting back to being a bit of a boring economist here. But I'm trying to say, why does debt matter? Because I often get asked this question by conservative economists. As long as we can pay the interest, who cares? Well, when you think about the amount of money you spend on an annual basis, you spend your income plus any change in debt. That's your total spending. And the same thing applies in an economy. In the economy as a whole, annual demand is the sum of income, GDP, plus change in debt. Now, the bigger debt gets to be, and the more rapidly it's growing, the more change in debt determines how much spending you're doing. So over time, the impact of increasing debt actually becomes dramatically more important than changes in GDP. And if you look back and chart the level of unemployment against the rate of change of debt, you find ultimately this incredible negative correlation. When debt rises much more rapidly, unemployment falls, and vice versa. And what I've then done over here is a correlation between the two and saying, if there's a change in debt, what's likely to be, is there going to be a change in GDP, a change in unemployment? Now, back in the 1960s, when debt was quite small, the correlation was pretty small and actually positive. So if debt went up, unemployment might also rise. Now, when debt goes up, unemployment falls. And the correlation is actually 90%. So it's highly likely that an increase in debt levels will be correlated with a fall in unemployment. So we are actually addicted to debt, a bit like a heroin addict. You're high as long as you're injecting the drug. When you stop injecting the drug, you're going to be depressed. And we've become dependent in that sense upon debt. So what happens after that? Well, we get something like the United States. The red line, which is graphed against the left-hand axis, is that same index I showed you beforehand of the value of American housing, the price you can average the price of an American house. The blue line is a monthly change in the price of American houses, and that is now below 1%. That's right off the right-hand side. That's what's driving the crisis we're seeing in America. Because people borrowed money to speculate on houses. You could make money if you borrowed money, sold the house, got the profit and got out early. And that works for individuals, but collectively, all it was doing is driving up American debt levels. And now they have a level of debt which is enormous compared to their GDP, far higher than Australia's, and they've got to sustain that somehow, and the economy is going into reverse. And the willingness of people to lend money is also evaporating, and the financial system itself is breaking down because a large part of financing involves exchanging debt instruments. And people are no longer willing to do that because they're no longer sure that when they give a bond to somebody for even 30 days, by the time they get it back, they're not sure that bond won't be worthless anymore. So we are in for really interesting times. And I think a serious downturn is inevitable globally, not just in Australia and not just in America, but globally. There are counterforces. Strangely enough, one of them is global warming and peak oil, even though they themselves are crises and are in many ways far more serious than the economic crisis I'm talking about. They will drive prices up. And that increase in prices will actually undermine the increase in debt we've accumulated. So ironically, they may actually help reduce the third crisis, which is the debt level. Strange but true.
You could put in inflation in food prices too?
Well, that's actually probably been driven by global warming and by the physical pressure we're putting on the planet, reducing the amount of land we have for food and so on, population pressure. I see it as related to global warming in that sense. And also
using part of that land to produce fuel for SUVs instead of food?
Yeah, that's right. We think we're going to replace petroleum with biofuels. We have to devote land we're currently devoting to food to grow petrol. So people are going to starve so they can drive their cars. It's not really a sustainable argument. China's also booming, and India. And they may give a bit of a counteracting force, but I think it's probably appropriate to finish with what's known as a Chinese curse. And that is the witticism of the Chinese, one way to curse somebody to say, may you live in interesting times. And I think we certainly do. Thank you.